We've seen in past videos that to achieve satisfying investment gains, we have to stay focused on the long-term trend, the evidence in the charts, and avoid emotional decisions. In this week's video, we'll look at how the market climbs a wall of worry and the importance of focusing on the evidence for long-term gains. We'll close with a look at price targets based on the charts we have in hand. We open with a summary of this week's economic data and interpretation. The economic calendar had important readouts this week on consumer spending, job growth, manufacturing output, housing, and the business outlook. Overall, the economy and business outlook remain very strong. Now we'll look at our week in review and the headlines that moved the market. On Monday, we had strong retail sales data that boosted growth in June. Not much action was going to take place prior to Powell's testimony on Tuesday and Wednesday, as an aggressive Fed and the prospect of an inverted yield curve remained market worry. The market closed down slightly. On Tuesday, the market was buoyed by strong manufacturing data and Powell's balanced testimony, which the market found soothing. On Wednesday, we had the second day of Powell's testimony, where investors focused on the words, "for now," in Powell's testimony regarding future rate hikes, signaling that we weren't dealing with an aggressive Fed on autopilot. On Thursday, initial claims came in at the lowest level since 1969, but the market grappled with multiple overnight political and trade headlines closing down for the day. On Friday, the market was impacted by additional comments from Trump on the Federal Reserve and tariffs. The week was relatively flat, leaving the month and year little changed. Before we look at the charts, we'll briefly touch on how these videos relate to our strategy. In the face of uncertainty, we want to use our evidence-based model to determine probable outcomes versus making emotional decisions with our money. Our strategy involves executing trades in two time frames, long-term and intermediate term. We monitor trend strength in our long-term time frame. Based on the long-term technical measures, including technical patterns and economic data, investments made on this time frame include core holdings in major indexes. These are multi-year holdings. The goal of monitoring the trend is to determine when the trend is ending for two purposes. First, to avoid the substantial drawdowns associated with buy and hold strategies, and second, to determine allocations in our intermediate holdings to growth versus defensive assets. The primary trend in the market is composed of sector rotation underneath the surface. The trend may be driven by small caps, financials, and technology for a year, and then rotate out some components to include perhaps services and conglomerates. This time frame also uses technicals, events, and economic data. These sector holdings rotate as the trend and business cycle progress. The balance of the allocations to growth and defensive sectors is in accordance with the strength of the trend, which is also a measure of the financial cycle. Evidence-based investing and trend strength is the majority of our focus in these videos. Now we'll move on to our main topic. This chart from Bank of America Merrill Lynch shows the monthly preoccupations of global fund managers going back to 2011. That's 86 months of worries. The concerns are grouped thematically in brackets at right. New worries, of course, constantly arise to take the place of old ones, and yet, over long periods of time, the market continues to climb this wall of worry. In the next several slides, we'll look at the human behavior that causes this. Worry is an investment bias that reduces our tolerance for risk, leading to jumping in and out of the market based on predictions of what might or could happen. This causes us to miss out on long-term gains. Fear of loss leads us to making emotional decisions and opens the door to other investment biases. Fear is related to uncertainty and the unknown, and the antidote is a disciplined approach that provides probabilities of potential outcomes. To combat fear of loss, in our opinion, investors should use strategies that have defined risk of loss, rather than being exposed to the maximum drawdowns that are associated with buy and hold strategies. The second bias is predictable human behavior that makes long-term trend following possible. The herding instinct. The herding instinct perpetuates and strengthens trends in the early stages, and as we know from last week's video, causes bubbles in the latter stages. One of the goals of our model is to identify extremes in herding behavior. The bottom of the correction on February 9th was an excellent time to buy from panicked sellers at low prices. As Professor Siegel said in the quote at the beginning of our video, the markets climb a wall of worry, and certainty usually signals the end of one trend and the beginning of another. At market tops, the uninformed public rushes in at high prices, believing the market will go up forever. Little do they know that they're the last ones to the party, and there will be no more guests arriving to buy their shares from them. The opposite occurs at market bottoms, where everyone is certain the market is just going to keep going down forever. At that point, there is hardly anyone left to sell, and buyers have to pay higher and higher prices, driving the market back up again. When there's worry, there's a trend, with buyers and sellers all weighing different concerns and opportunities. Sector rotation continues under the surface of the main index all throughout the trend, up and down, as economic conditions and trend strength change. So fund managers, by and large, are no different than any other human beings. Here again is the list of fears that they were captivated by going back to 2011. Each fear was real, and it is quite common to feel that this fear is different than any other fear that the market has ever faced before. Money is on the line, and no one wants to lose, but many sold out anyway. Did the market climb a wall of worry? Over the same period of 86 months, or 2,607 days, the market gained 146%. If we want to achieve these types of gains, we have to focus on the evidence and the trend using a disciplined, model-based approach versus making emotional investment decisions. This slide is from our May 11th, 2018 video, where we showed the symmetrical triangle pattern in the market and provided a probable price target of 300 in the SPY ETF, or 3,000 in the S&P 500. Our model doesn't use patterns, but we're constantly monitoring patterns in the market and what they tell us about the probabilities for our investments. Let's look at the next slide to see how we're progressing. As we indicated in May, it was quite likely we would break out of the pattern to the upside, and already we've gained 12 points towards our 30-point target. Is the price target a prediction or a probability? In our book, it's a probability. The market is full of risks, and a series of events could derail the market, or there could be a sudden shock. But we have to deal with the probabilities we currently see on the charts. This chart reflects the current probabilities. Should they change and portend to a bear market, we would expect to see those probabilities reflected in the charts as well. This is the difference between evidence-based investing and emotional decision-making. Now we'll look at another pattern called a cup and handle pattern. The cup is formed by a rounded bottom, and the rim is formed by a line across the top. The handle is formed by a throwback. The breakout from the pattern occurs above the handle at the level of the rim of the cup. This pattern is considered a continuation pattern if the preceding trend was bullish. The price target for this pattern is calculated by taking the distance from the right peak to the base of the cup. In this case, the distance is 23 points. This is added to the break above the handle for our price target of 301 points. This is a pattern which speaks to probabilities. Again, no one pattern is predictive. We look at the pattern in the context of all the other evidence in our model to determine probabilities. A high probability of continuing to the upside never eliminates the probability of the pattern failing. Overhead is a line of resistance that could come into play, or a new event could unfold that tips the balance of the market to the downside. Again, the charts would speak to the probabilities. Hopefully now you see the benefits of looking at evidence to determine probabilities versus making predictions. Predictions have true or false outcomes, and in complex systems like the stock market, even experts can't accurately predict what will happen. And the financial media makes good money by getting people to read scary articles and then to follow up with reassuring ones. As we look at these examples, think about whether you should rely on these expert predictions and headlines to determine when to get in and out of the market. Alarms over the yield curve versus not fearing the yield curve. Powell saying that a trade war could hurt the economy versus Mohammed El-Arian's assurances not to worry because we're winning the trade war. Global growth peaking with a whimper, or the International Monetary Fund saying that we've reached a record in global growth. Well-known fund manager Gundlach saying we're getting closer to a recession, versus Larry Kudlow citing strong economic data to say that there's no recession in sight. The majority of economists saying that we're facing a Fed on autopilot that might trigger a recession, versus Chairman of the Federal Reserve Jerome Powell testifying that the Fed is not on autopilot. Would you rather invest based on conflicting expert opinions you saw on the previous slide, or the evidence you can see on the charts? Human behavior is predictable. Remember when we talked about fear of missing out? There are a lot of people afraid of missing out on a surge in stocks when we cross the red line and come out of correction. Perhaps the worries, conflicting headlines, and expert opinions, combined with predictable human behavior such as the fear of missing out, will be enough to keep the market climbing the wall of worry and lead us out of the correction onto new highs. While the market continues to climb the wall of worry, our job is to ignore the opinions and the headlines, to stay disciplined, focus on the evidence, and allocate appropriately for the outcomes with the highest probabilities. The information in this video cannot address the specific investment objectives, financial situation, or particular needs of any viewer. The information presented is solely for informational purposes and is not a solicitation or offer to buy or sell any security or financial instrument. None of the information in this video should be taken as investment advice. Any opinions expressed in this video are subject to change without notice. Caliber Capital Management, LLC, or KCM, is not under any obligation to update or keep the information contained in this video current. KCM, its officers, employees, or clients may have an interest in the securities, related securities, or derivatives of the securities referred to in this video. KCM accepts no liability whatsoever from any loss or damage of any kind arising out of the use of all or any part of this material. KCM recommends that you consult with a licensed and qualified professional before undertaking any investment decision.